Good afternoon. This is Ken Long from Tortoise Capital Management with an executive summary of the weekend reports for March 12th, 2011. Pardon my head cold. We're in bullish, volatile conditions at the high end of normal on an annual basis using weekly RSI. On a 10-day index, we're at the low range of normal at a score of 32. The stretch above the 200-day moving average and the slope of the 50-day moving average are both rated at green, although both have moved considerably off their highest highs of 2 weeks ago. ATR percentage has increased to 1.52%, putting us at the high end of volatile, and it's 3 times as volatile in the market now as it was at the end of December. The U.S. is slightly above average in strength compared to the other regions, with Asia lagging significantly. Precious metals, especially silver, are dominating. The agriculture ETFs have pulled back a little bit, but they're on 5-day down signals right now, and there's a potential for another leg up, especially given the horrible news coming out of Asia and especially Japan. Our hearts and prayers go out to the Japanese and anybody who's been caught by that catastrophe. Monthly and quarterly rebalancing, no change. The next due date for rebalancing is 1 April. In ETF2, our theoretical exposure is reduced to 20%, with only U.S. small caps and mid caps being positive on a 5-week rate of return. The model portfolio is reduced to 70% exposure, with selling of 3 positions, QTEC, IWP, and IGN, all U.S. technologies, which have started to lag the broader market. We've got one stop in energy to update in ETF2. In the market health check, we're looking back 10, 20, and 30 days. You can see ADX has pulled down almost to 15, has started to hook back up, but the bad news is that the increased strength of trendingness is coming from the bearish moves, as you can see by minus DI being higher than plus DI. We've pulled back from the swing high of 2 weeks ago from 135 down to 129.5. We closed just above that on Friday's directional move. But that takes us right to the boundary now of a 5% pullback from a swing high, which is the boundary between normal market noise and the beginning of a significant test of the bull market. A 10% correction would take us back to about 125.5, which would be well below the 50-day moving average and well outside the regression channel, looking at the 30-day regression line. On an annual basis, we remain overbought significantly, and oversold on a 10-day basis, which was the beginning of that channeling pattern. Inside the ETF2 model, you can see 8 of the 10 regional indexes are negative on a 5-week rate of return, with the strength being in mid caps and small caps. Europe is stronger than Asia. U.S. is slightly stronger than Europe. Inside the world market model, you can see the strength in all commodities, oil, gold, and silver. Asia really suffering. U.S. mid caps and to a certain extent large caps doing well. Asia generally lagging behind the U.S., but not as bad as Europe. The energy and materials sectors have given back, and I think that's probably a result of that rising oil prices. So that may reverse itself here as oil starts coming down. But you'll notice the defensive sectors of staples, utilities, and healthcare have now caught back up to the broader market. Finance continues to lag behind. In the 100 by 200 system, all of the globals have gone to cash as price has begun to decay. The U.S. remains relatively healthy. The top 30 ETFs are dominated, as per last week, by precious metals, basic metals, commodities, energy, although we have seen pullbacks in everything really except silver this week. Even silver showed some signs of cracking as well. So I would play that one very close to the vest. In the ETF liquidity report, these are the top 30 by daily dollar volume. Those highlighted in green are those that are exceptionally volatile intraday and make excellent trading candidates. So energy, silver, oil services, the VIX especially at over 6.33% intraday volatility is a terrific short-term candidate for trading for the agile. And that concludes a quick review of the weekly report. This is Ken Long from Tortoise Capital. Keep your powder dry and your risk managed.